Hello and welcome to another episode of Full Court Finance here at Zacks. And today we're taking a look to see if investors should buy these three particular Magnificent Seven stocks and possibly hold them for the long term heading into their earnings releases next week. And the three stocks we're looking at today are Apple, Amazon, and Meta. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look in some of our services, portfolios, and more. So before we jump into these three major reports for next week and seeing if investors should consider buying these three big stocks, it's worth just quickly going over what's happened so far in terms of the earnings releases. So most of the heavy hitters, as we're about to mention, don't report until next week. But the early wave of results has been rather bullish outside of Tesla's disappointing showing, which we'll touch on in a little bit. So beyond that EV powerhouse and a few others, the early wave of earnings and guidance has showcased pretty impressive resilience. So things appear to be going rather well in the U.S. economy when you have Netflix, United Rentals, American Airlines all soaring after their earnings releases. These companies operate in totally different sectors of the economy, and together they showcase the strength of the American consumer. And then in the case of United Rentals, which rents large equipment to customers across construction, utilities, energy, home builders, and beyond, that large projects are going pretty smoothly across various industries as well in the U.S. The most recent Zacks data also highlights an improving fourth quarter earnings outlook for the S&P 500, which is coming against a beaten down base, but still a positive sign to see earnings trending. The earnings outlook's trending higher as results roll in. And if we look ahead to 2024, we're calling for 11.3% earnings growth and then 12.5% earnings growth in 2024 against what is projected to be about 3.6% earnings decline in 2023. And then if we look just back to Tesla real quick before we jump into these three reports, from a purely technical standpoint, it's one of the Magnificent Seven stocks that's actually not performed well recently at all. It's down 30% in the last 6 months, trading below its 50-week and 200-week moving averages, so those long-term moving averages. And the selling has sent it to some of its most oversold RSI levels since it bottomed in early 2023. So if buyers start racing back into Tesla and Microsoft and Alphabet and Apple and Amazon and Meta, which are some of the stocks we're talking about today, offer up solid guidance next week, the bulls could really be able to turn back up the heat in the long run. So speaking of, we're going to jump into those three stocks. And obviously, none of these stocks aren't hidden gems, but that's kind of the point. Sometimes buying the favorites and betting on the favorites is a good strategy, especially as part of a diversified portfolio. So you can always be looking for that next Wall Street Titan. You can be looking for the next Apple and the next Amazon while also owning Apple and Amazon and Meta. So we're going to check out those three stocks I mentioned. So the first one of those we're going to talk about is Meta Platforms, which trades the ticker META. So Meta, the company reports its Q4 2023 earnings results on Thursday, February 1st. So all three of these companies, all report next Thursday. So despite concerns about slowing ad spending and the growing saturation of Facebook and Instagram, the company still grew its daily active users, which they call people, by 7% last quarter to a mind-blowing 3.14 billion. Meanwhile, its family of platforms, so that's Facebook, Instagram, and WhatsApp, hit monthly active users of 3.96 billion, so nearly 4 billion people, which is roughly half of the global population. That was also up 7%. It's just mind-blowing to think they reach half the global population when a lot of people don't even have access to the internet. So it's even more of a population that actually has access to any of these apps in the first place. So its various apps are focused on different niches of the social media and digital communications space. They attract advertisers who are obviously still clamoring to reach the massive user base in a world where people are simply just glued to their phones. All this means that Mark Zuckerberg's metaverse bet doesn't have to pay off anytime soon, and really if ever. And its balance sheet remains so robust that it's going to be able to grow into new areas that maybe we don't even know of yet. And it's already investing in its AI future as well, like all of these tech companies are at the moment. Meta might not scream value stock at the moment either, considering it's soared about 160% in the last 12 months to crush the tech sector. It's also up 33% in the last 3 months to hit brand new highs, having erased all of that downturn at this point. Yet the parent company of Facebook and Meta, Facebook, WhatsApp, and Instagram trades at a 16% discount to the Zacks tech sector and 10% below its 10-year medians at 24.2 times forward 12-month earnings, and it's trading 67% below its 10-year highs. And its PEG ratio, which factors in its longer-term earnings growth outlook, sits at 1.1 versus tech's 2.2. So really, it's looking like a value stock at this point, as crazy as it sounds. The stock is a little overheated in terms of RSI levels. So if you look at that RSI indicator over the last decade, it's sitting at pretty heavily overbought levels. So we could see a pullback, and kind of a pullback with all these stocks. But as the theme will be, if you're a longer term investor, as we saw with this massive downturn for Meta, if you just continue to buy the dip on Meta, it would have turned out to be a very profitable trade for you in the long run. So if you want to time these stocks, maybe you wait for a pullback down to longer term or shorter term moving averages with all of these stocks that we're going to talk about today. So Amazon and Apple included. But if you're a longer term investor, you don't necessarily want to try to play the timing game, because that can be a very difficult game to win. So like a lot of the companies in the tech world these days, so higher interest rates, Meta's focused on churning out profits, and we can see that in its earnings outlook. So we're calling for 46% adjusted earnings growth this year, and then another 23% adjusted earnings growth next year, to help it grow its revenue by about 15% this year, and then another 14% next year. So really impressive top and bottom line growth. The company's positive earnings revisions outlook helps it land a Zacks rank number 2 buy at the moment as well. And it is in a industry that sits in the top 21% of over 250 Zacks industries. And its overall earnings outlook, has just trended straight up essentially since the start of 2023. And it's now all their earnings outlooks are continuing to trend higher. So if you're a longer term investor and you want to consider Meta for all of its various apps and its ability to kind of go into any future growth areas, considering its balance sheet and its valuation levels at the moment, certainly worth considering, though there could be a pullback even if it impresses, considering how much it's jumped heading into this earnings release next week. And now we're going to move on to Amazon, which trades in the ticker AMZN. Most people know that. So its Q4 2023 earnings results are also, as I said, due out on February 1st, so next Thursday. The company's rebound kicked back into higher gear following a big beat race third quarter back in October. The e-commerce and cloud computing giant's comeback has been fueled by its commitment to boosting earnings and transforming into a more mature tech company that posts impressive top-line growth and massive, consistently expanding earnings. So that's what the big post-COVID, higher interest rate reset has had all these tech companies focus on profits more than just breakneck expansion at all costs. So some investors might be worried that they, quote, missed out on Amazon's rally, as they might be worried they missed out on Meta's rally and Apple's. But if you're a longer-term investor and you're betting on the next 10 years, it's not a shocking thing to say that these stocks will probably be higher than they are at the moment. So considering the multiple growth engines the company has, slowing cloud growth and higher rates hit Amazon stock in 2022, but the rates are coming down, and as I said, Amazon's focused on maximum profits and efficiency under its new CEO Andy Jassy. I guess he's not really new at this point, but it's no longer the big man who started it all. So better yet, Amazon still runs the world's largest cloud computing business, and cloud computing is a key pillar of the modern economy, and it's only growing in importance. So the combination of steady cloud computing growth and a concentrated effort on boosting earnings has been something that Wall Street's really backing in on Amazon stock, seemingly all in back in on Amazon stock. And it's attempting to obviously improve its margins by rolling out more in-house chips for its AWS cloud computing business. And it's also rolling out, as this is the theme for everybody in tech, more AI-focused efforts to attract customers to spend more on its cloud computing business. On top of that, it has a collaboration with NVIDIA for cutting-edge chips for that AI. And then on the e-commerce front, Amazon's benefiting from the transition from a single national fulfillment network in the U.S. to 8 distinct regions. It's helping with its bottom line. It currently holds nearly 40% of the total e-commerce market share, which is blowing away second place Walmart, which is at around 7%. And it's got a growing digital advertising business. That segment climbed 25% in Q3, marking the largest year-over-year gain on a percentage basis out of all of its big businesses. And it's also continuing to focus on rolling out more efforts on the Prime services outside of the delivery, getting into more live streaming sports and things like that, just to keep people in that service for as long as possible. So looking ahead, we're calling for 11% revenue growth this year and then 12% revenue growth next year. And then on the bottom line, we're calling for 280% adjusted earnings growth from 71 cents per share all the way up to $2.70 per share. And then another 35% growth on top of that to $3.66 next year. So just this impressive bottom line growth, which is why Wall Street's so hyped on a lot of these stocks who are now focused heavily on profits, because as we know, earnings and interest rates are what drive stock prices. So as interest rates are going down and earnings are trending in the right direction, that's why all these stocks are up big. And just to put their top line growth in perspective, the company is essentially expected to add about $124 billion between 2022 and 2024, which would see it pretty much add more to the top line during that stretch than Target made in all of last year. And its earnings revisions keep trending higher, so it lands a Zacks ranked number 2 buy at the moment. Now let's look a little bit at performance and some technical levels and valuation before we move on to the last stock today. So Amazon stocks climb about 780% in the last decade, crushes the wider Zacks tech sector, which is up about 280%. Despite that run, Amazon's actually down 2% over the last 3 years, and that falls way behind the Zacks tech sector, which is up about 27%. And it's still trading around 15% below its all-time highs. So while a lot of these big tech companies are at brand new highs, Amazon's still sitting below where it was several years ago. So that's a positive for investors worried that it might be a little overheated. And it still is a little overheated if we consider just how much it's run up over the last year plus, and it's now at pretty heavily overbought RSI levels like a lot of these stocks are. So we could see a pullback, as I mentioned, with all these stocks in the near term. But if you're a longer term investor, it's kind of up to you if you want to play the market timing game on all of these stocks. And then on the valuation front, it's trading over 65% below its highs and a 45% discount to its 10-year median. And this is still where it's a little pricey. I mean, it's trading at 42.8, so 43 times forward 12-month earnings, which is still really pricey for a lot of investors. That's why they're still focused so heavily on growing the bottom line. But then if we look at its PEG ratio, which factors in that longer-term earnings growth outlook, it's sitting at a 25% discount to the Zacks tech sector at 1.5, and it's now sitting at near its lowest levels over the last 10 years. So it's still a powerhouse in really key growth areas of the economy that aren't really going out of style. They're just entrenched at this point: cloud computing, e-commerce, things of that nature. So it's kind of a straightforward bet on mega cap tech as a way that's going to continue to play really huge sway over our lives in the market. So Amazon's certainly worth a look heading into its earnings results next week. And then last up is Apple, which trades on the ticker AAPL. Once again, none of these stocks are hidden gems, but that's kind of the point. Apple was actually my bull of the day from earlier this week, and the company reports its Q1, so its first quarter of 2024, so it's fiscal 2024. Its earnings on February 1st as well. So the stock actually ended 2023 and 2024 on a rather downbeat note as analysts kind of raced to outsmart themselves and give downgrades for various reasons based on concerns about slowing growth in China and other headwinds. But the stock's up about 8% since early January and approaching its mid-December records as we head into that report next week. And let's just jump kind of right into the negativity before we jump into why you might want to be bullish long-term on Apple. So a few notable analysts downgraded Apple stock over the last month or so based on concerns about slowing iPhone sales, with a particular focus on China, among other wider fears about an increasingly saturated high-end phone market. There's also kind of constant fears about legal battles regarding the App Store, and it's facing mounting competition from Huawei in the world's second largest economy. It's suffering setbacks in China more broadly, as the Chinese economy slows, which is impacting many other companies as well. And then there's geopolitical fears between the U.S. and China, obviously hanging over all of this. So that's kind of the big, broad negative case against Apple, and its year-over-year sales declined in the trailing 4 quarters. So its total FY 2023 revenue was down about 2.8%, which is actually its third year-over-year decline in the last 8 years. And despite all that, the company is churning higher. It's still a little bit more of a cyclical business than a lot of these other big tech companies, because they are still a lot based on big runs of the iPhone. So if there's a great new iPhone that everyone buys in these cycles, that does sway their results, and then have these kind of uneven years where if there's a big release that an iPhone did well, the next year might have a year-over-year decline. And that's why we're going to get into why Tim Cook's been so heavily betting on the services growth. But despite obviously these mounting concerns about Apple's business in China and the economy more broadly, its revenue in China actually only slipped about 2.2% in 2023 versus Apple's wider decline of 2.8%. And Apple's total iPhone revenue fell just 2% last year, and it actually climbed in the fourth quarter, was up 2.8%. So that's a positive sign heading into 2024. And then overall, just kind of more broadly, the bullish case for Apple is that its branding power kind of remains unmatched. It's it's in that constant cycle of new phones and devices that keeps people wanting more. Many consumers kind of upgrade to new iPhones and other devices habitually, even if there's not these game-changing differences. Apple sold $200 billion worth of iPhones in 2023, up from $142 billion in 2019. So massive growth there. And the case is not really that difficult to make for Apple in a world where everyone is just simply addicted to their smartphone. And the subscriptions unit is then what we're going to talk about now. So they're trying to make a lot more money from the constant business there, where everyone has an iPhone already. So what they talk about is their installed devices. So Apple said last quarter that an installed base of over 2 billion active devices that's continuing to grow at a nice pace. So what they want is people who have iPhones to be then subscribing to their various services. So they have obviously the App Store, then they have a Netflix competitor and a Spotify competitor, subscription news offering. There's Apple Wallet. There's a video game platform, digital workout classes, and tons more stuff. So the company said it finished its most recent period with over 1 billion paid subscriptions across its services, which was nearly double the number it had 3 years ago. So that's another bullish case for Apple long term. On top of that, it's brought more of its chips in-house, and it's quietly spending heavily on rolling out AI features into its smartphones and other devices. And then earlier this month, Taiwan Semiconductor reported upbeat results and provided strong guidance that would suggest that the smartphone market's going to return to growth. So with this in mind, Apple's revenue is projected to climb about 3% this year, and then jump 6% higher in its 2025 to reach about 418 billion. Meanwhile, its adjusted earnings are projected to grow about 8% this year, and then another 9% higher next year, which would come on top of marginal earnings per share growth last year. It's also easily topped our earnings every quarter over the last 5 years, besides a small miss in the first quarter of last year. Better yet, Apple's earnings revisions have trended higher over the last year. It was the Zacks ranked number 1 earlier this week, but it slipped to a number 3 hold with some downward revisions, but then we've had some upward revisions more recently. So we'll see how that plays out with its report next week. So as I said, with all these companies, if you are trying to get in just for a post-earnings pop, maybe not the best idea, or a trying to short the stock or something like that on a post-earnings dip, that's always a very risky proposition. So we're making the longer-term case, as I said, for all of these stocks. So Apple stock's up around 8% since January 5th. It's trading at about 6% discount to the average Zacks price target, and still below its mid-December records. The rebound, though, has it back above its 50-day and 21-day moving averages, and from oversold RSI levels to about neutral. And overall, it's just been a big winner over the last 10 years. It's up about 1,000% versus the Zacks tech sector's 280%. That said, it's only up about 33% in the past year versus Microsoft, which is up 63%. And it's actually lagged the wider tech sector during that stretch. So it might be a little less overheated than some people think compared to the broader tech space. Valuation-wise, it's trading at a roughly 20% discount to its 5-year highs at 28.8 times forward 12-month earnings, and not too far above its median. And then we should also note that it returned $25 billion to shareholders last quarter via buybacks and dividends. It's heavily investing in its future endeavors. As we mentioned, AI, they're thinking about getting into the electric vehicle space, things like that. Who knows what the company could look like in 10 years? That's kind of what you're betting on, along with smartphones and services, is just them coming up with something new. I mean, think the iPhone was something no one even thought about, and the iPod and all of those things. So that transformed Apple, and maybe they could transform again. So obviously, we're always looking for the next Apple and all the next Amazon and the next Meta, but sometimes betting on the favorite in the moment and having that be a part of your portfolio is a winning strategy. So that does it for today's episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.